Hello folks, you're watching Ditto Insurance. I'm Shashank and today we're not comparing any policies nor are we doing any reviews. We receive a lot of queries from you folks time to time and our amazing product team at Ditto have compiled all the queries and have clubbed it into a single FAQ session. So today we'll be answering your long-standing queries about term insurance. Also, if you're hunting for the best term plan to secure your family, then talk to us for free. Our advisors will help you select the right plan, help you right from application till the issue. And also, our services including claim support is totally free of cost. Book a free call with the link in bio. Alright, let's start with the first question. Is term insurance still worth it if I already have savings and investments? Yes, term insurance remains highly relevant even if you have substantial savings and investments. You see, it's not designed to grow your wealth, we get it, but to protect it. In the event of your untimely death, term insurance ensures your family doesn't have to dip into or liquidate long-term investments, those earmarked for critical goals like retirement, children's education, or wealth creation, just to meet basic living expenses or clear any outstanding liabilities. Also, this protection gives your loved ones financial freedom and peace of mind while allowing your investments the time they need to grow and compound uninterrupted. In essence, term insurance acts as a buffer, preserving your financial strategy and ensuring that your wealth continues to serve its true purpose. Alright, the next question. How do I decide between a return of premium, that is ROP plan, versus a regular term plan? Okay, we get this a lot, so let's clear it. Return of premium plans or ROP plans refund your premiums if you survive the policy term. But this feature comes at a significant cost, usually 70 to 100% higher premiums than regular term plans. While this may seem attractive, it's important to understand that you're simply getting your own money back without any real returns. There's no interest or growth on the refunded amount, meaning the value of money lost to inflation over the years isn't accounted for. Although ROP plans currently attract a lower GST rate compared to regular term plans, the math still favors a pure term plan. By opting for regular term insurance and investing the premium difference in instruments like mutual funds or fixed deposits, you give your money the potential to grow and compound over time, leading to far better outcomes. In most cases, a regular term plan coupled with smart investing offers better value, higher flexibility, and greater financial sense than an ROP plan. Alright, the next question. What happens if I develop a health condition after buying the policy? Okay. So once your term insurance policy is issued, your premium remains fixed for the entire duration, even if you're later diagnosed with a critical illness or develop any serious health condition. The insurer cannot increase your premium or cancel the policy due to changes in your health status. You see, this is one of the biggest advantages of buying term insurance early on in your life. When you're young and healthy, you can lock in a low premium for the entire policy term, ensuring long-term coverage without worrying about future medical uncertainties. You see, it's a proactive way to secure your family's financial protection regardless of what happens to your health later. Alright, the next question. Can I have multiple term insurance policies from different insurers? Yes, definitely you can absolutely have multiple term insurance plans. Just make sure to disclose all existing policies when applying for a new one. This helps insurers assess your total coverage accurately. Also, your combined life cover should align with your income and financial profile. It shouldn't exceed the maximum eligibility set by insurers, which is usually based on your age, education, and annual income. Alright, the next question. Can I change my nominee later? Well, yes, you can change your nominee at any point during the policy term. You see, for most online policies, this can be done easily by logging into your insurer's customer portal and updating the nominee details by yourself. There's no paperwork needed. For offline policies, you may need to fill out a nominee update form and submit it to the insurer. Alright, the next question. Can I add multiple nominees? Yes, you can add multiple nominees. You can also assign a percentage share to each. For example, 60% to your spouse, 40% to your child. Just keep in mind that the total share must always add up to 100%. Also, the maximum number of nominees you can add may vary depending on the insurer and the policy. So it's good to check those limits before proceeding. Alright, next question. Should I buy a term insurance policy online or offline, and what are the differences? Okay, you see, both options have their pros and cons, and the choice really depends on your preference. Let me tell you what happens when you buy a policy online. It's usually more affordable due to zero agent commissions. They're quick, paperless, and hassle-free, and everything from purchase to updates can be done digitally entirely. Also, it's ideal for those who are comfortable with online transactions and decision-making. Online, it's easy to compare multiple plans and reviews. Now, if you come to offline, this usually involves an agent or visiting the insurer's branch. It does offer a more personalized and guided experience. Premiums may be slightly higher due to agent fees. The process, you can expect it to be a little slower and more complex due to physical paperwork, and any updates or corrections like nominee change or address update, they will require you to have a physical documentation done. And today, most insurers have shifted to online first processes. So this makes it more convenient and a time-saving option. You can buy and manage your policy in just a few clicks, and you don't have to wait in queues. In contrast, offline plans often involve a lengthy process and multiple visits to the branch, which can feel like a hassle. So irrespective of the channel the term plan is purchased from, the claim support and experience will be uniform without discrimination. All right, next one. What is MWPA and should I opt for it? Okay, so MWPA first of all stands for Married Women's Property Act. When you take a term insurance policy under MWPA, the entire death benefit is legally protected and can be claimed only by your wife and or children. This ensures that the payout is shielded from creditors, business liabilities, legal disputes, or claims from extended family members. So this makes it especially useful if you have unsecured loans or potential inheritance issues. That said, keep two things in mind though. You can only opt for MWPA at the time of buying the policy. It cannot be added later to an existing plan. And once assigned under MWPA, the beneficiaries are fixed. You cannot change or remove them. So go for MWPA only if you're 100% sure about who you want the payout to go to. It's a smart safeguard if you want to lock in protection for your immediate family, especially in complex personal or financial situation. All right, moving to the 9th question. What happens if the insured and nominee die together? For example, in an accident. Well, that would be really unfortunate. If both the policyholder and the nominee pass away at the same time, this is what happens to the insurance payout. If there was only one nominee and they are no longer alive, the claim amount is paid to the legal heirs. That is based on succession laws or a valid will. If there were multiple nominees and one passes away, the remaining living nominee will receive the payout as per the assigned share. Now, this is why it's important to keep nominee details updated and consider adding multiple nominees if required, where possible for added clarity. A legal will also help in this scenario. All right, moving to the 10th question. How much term insurance cover should I take and for how long? Oh God, we get this a lot. Your ideal cover depends on your age, income, education, existing policies, family setup, future goals, and overall financial responsibilities. Typically, you should aim for a sum assured that's around 20 to 30 times your annual income, though the exact limit also depends on the insurer's eligibility criteria based on your profile. You can use Ditto's free calculator. I will link it in the description. You can check your number here. As for tenure, a policy that runs till age 60 or 70 is usually ideal. Beyond 70, premiums shoot up due to higher mortality risk, and in most cases, your dependents may already be financially independent, reducing the need for continued coverage. Does my term insurance cover me if I move or die abroad? Yes, first of all, yes. Term insurance plans offer worldwide coverage, so you're protected even if you relocate or pass away outside India. However, it's important to inform your insurer about your move and update your contact or residence details. In case of death abroad, the claim remains valid provided all necessary documents like death certificate, embassy attestations, etc. are properly submitted. Also note that the claim payout will be done in Indian currency only. Folks, also remember, in case the country you are moving to is an insurer's restricted country list or a war zone, example Iraq, North Korea or Syria, then they may deny the coverage in that country. Alright, next question. Are medical tests mandatory for term insurance? What kind of tests are done and who pays for them? So 100% yes, medicals are generally mandatory for every applicant regardless of profile. Now, depending on the insurer's assessment, it could be a telemedical, physical checkup or both. The type of test varies based on your age, disclosure and overall risk profile, but it commonly includes blood and urine test, BMI and basic fitness checks. For applicants residing in India, the cost of medical tests is usually borne by the insurer themselves. However, for NRIs applying from abroad, the cost of the test for majority of the insurers is typically paid upfront by the applicant and then reimbursed up to a certain limit. Alright, let's head to the next question. Are NRIs eligible for GST waiver on term insurance premiums and how does it work? Alright, yes, NRIs are eligible for GST waiver on premiums paid for term insurance. To avail this benefit, the premium must be paid through an NRE, that is non-resident external account, and the applicant must provide the necessary residency and account related documents. Some insurers offer the GST waiver upfront during the application process, while others may refund the GST later once valid proof of NRI status and NRE account payment is submitted. Alright, next question. What is Section 45 in term insurance? If your term policy has completed 3 years from latest of policy issuance, risk start date, revival or any rider addition, then the insurer cannot question the policy or reject a claim unless fraud is clearly proven by them. So after 3 years, your claim is practically guaranteed. However, during the first 3 years, the insurer has the right to verify all details you submitted. Now, if they find any issue like non-disclosure, misstatement or hiding important information, they can cancel the policy and may not refund any premiums. If death happens during this period, the claim may be denied too. That's why it's very important to disclose everything honestly, health issues, lifestyle habits, past illnesses, etc. while applying for the plan. Folks, when you purchase a term plan through Ditto, or when you have Ditto by your side to compare different term plans, we tell you that you need to disclose everything. We basically tell you how the whole application process goes, what happens and what doesn't. So if you want a complete hand-holding process from Ditto's side, then head to the link in the description and book your free call. Let me remind you that our services are completely free of cost to you, and we will be there with you right from the application and till the claim process as well. Alright, moving on. What if I was a smoker when I bought the policy but later quit, or vice versa? Will my premiums change? Well, sadly no, your premiums will not change once the policy is issued. Now, if you were a smoker at the time of purchase and later quit, your premium will stay the same. There's no reduction. Good thing that you quit smoking. But similarly, if you were a non-smoker when you bought the policy but later started smoking, your premium won't increase either. That's because term insurance premiums are locked in based on your declared risk profile at the time of application. However, it's still important to disclose major lifestyle changes even after the policy is issued so that there is no issue in case of future claims. Alright, 3 more questions. What if I have a risky job like I'm in aviation, mining or armed forces? Will I still be eligible for term insurance? Definitely, you may still be eligible, but it depends on several factors like your age, income, education and overall profile as I mentioned. When you mention a high-risk occupation, most insurers will ask you to fill an additional occupational risk questionnaire to better understand the nature of your work. Based on their assessment, the insurer may do one of the following. They may issue the policy as is, which is the best case scenario, reject the proposal altogether, make a counter offer with higher premium to cover additional risk. They might reduce the sum assured or tenure, or they might remove or modify certain riders if you've opted. So it's not a straight yes or a no question. It's a case-by-case decision based on how the insurer evaluates your risk level. So if you have doubts regarding that, you know where to find us. The link is in the description. Alright, last but one question. What happens to the premium if the insurer rejects my application or if I cancel it myself? Alright, this is also something that we usually get. Now, if the insurer rejects your application, your entire premium amount is refunded. Now, let's say you cancel it yourself before the policy issuance, your entire premium is again refunded. If you cancel after the policy is issued and you're still within the free look period, that is within 30 days, you get the premium back after deducting stamp duty charges, proportionate premiums, and medical costs borne by the insurer. If cancelled after the free look period, no refund is provided, as term plans typically don't have surrender value unless you have opted for ROP, that is return of premium variant, or are exiting in a specified window of a zero cost plan. Now, last question. What are the tax benefits of term insurance? Alright, as you know, we have 2 tax regimes, old and new, and under the old tax regime, term insurance offers 2 main tax advantages. The first is Section 80C. You can claim a deduction of up to 1.5 lakh rupees per financial year on premiums paid towards your term plan, as long as the premium does not exceed 10% of the total sum assured. The second is Section 10D. The death benefit payout received by the nominee is completely tax-free, irrespective of regime. Now, important note, while the claim amount itself is tax-free, if your nominee invests this amount elsewhere like FDs, mutual funds, etc., then any returns or gains generated from that investment can be taxed as per applicable rules. And the 80C deduction has been removed in the new tax regime. So, folks, We have almost covered 18 questions, I guess. Yeah, and we'll be back with a health insurance FAQ session as well. Folks, if you found this video helpful, then please drop a like. It's free for you, but helps a lot of other people discover our video and will be helpful for them as well. If you have any doubts regarding term insurance or health insurance, then book a free call with us. Our IRDI certified advisors will help you from step 1 till step N. And for more videos in insurance, don't forget to subscribe to Ditto Insurance. I'll see you in the next one. Until then, happy insurance hunting.